Hello and welcome to the show. Today we'll be talking about metamaterials and metamaterials torchlight preferred shares. This is an overview and update, so it could be useful for for people new to the subject matter. So it is May 6, 2022 at the time I'm making this video. Let me start by saying that I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So with that, let's get going. George Palikaris is the CEO of metamaterials, stock symbol MMAT. He makes tweets occasionally, and this is one of his last tweets. If we look, we can see that there's a microwave oven and some popcorn. So he's tweeting about popcorn. Well, he's really tweeting about the microwave oven, and if we look at the oven a little bit in detail, we see that there's some very clear glass on the front of the microwave oven. Usually the view to the interior of the microwave oven is obscured because there's a wire mesh that is there in front of that's there behind the glass, and that protects the users from harmful microwave radiation. Well, this microwave oven doesn't have that because it's got some new glass from metamaterials, which basically reflects all of that microwave energy back into the oven, keeping the user safe while still providing a very clear view to the interior of the oven. Metamaterials also released they announced a Form 10-KA, which was released. I'll be talking about that later. It's an amendment to the Form 10-K, or the annual report, for the year ended December 31st, 2021. It's a pretty hefty release, and I'll talk about that later on in the video. So just keep it in mind that it's been released. Also, Q1 results for 2022 are coming out. There'll be a discussion about it. They announced a dial-in, so be sure to check it out and check out what the results will be for the dial-in. They'll be talking about Q1 results 2022. With that, let's look at some price action. Okay. So this is metamaterials share stock symbol MMAT. Ended the week around $1.17, mostly going sideways. This is it for the year. So yearly, going back 52 weeks, we can see that the stock is mostly down, and it's down significantly, right? Split adjusted, it had a high of over $18 a share, and we're at $1.17. So there's a lot of room for growth to get back up there. Mostly the reasons for the short, the reasons for that the stock is down significantly is that it suffered a short attack by hedge funds such as Carousel Capital. I won't get into that in this video for now. But anyway, moving on. Price action. MMTLP, this is the metamaterials torchlight preferred shares, ended the week around $1.27, going mostly sideways. And if we look throughout its entire trading history, which was all the way back till October 7th or so, it's been going mostly sideways for the most part. If we look at oil, West Texas Intermediate, oil ended the week at $109 per barrel, and that's mostly up. And if we look at it in the long term, going back to 2021, we see that it has been, again, mostly up. It's gone from somewhere around $46 or a barrel or so, reaching a high of almost $130 a barrel, ending this week around around $110 per barrel almost. And that has an effect on everyday people, right? If we look at the price of gas, this is in California, we can see that it was recently going to almost $6.50 for premium, $6 for regular, so $6.10 for regular. It's pretty pricey as far as I'm concerned. But I would be a lot more concerned if I didn't know what I knew about metamaterials and torchlight. So let's tell a story. This is the overview of torchlight and metamaterials. And it tells the story of two companies. There was Torchlight Energy, which is an oil and gas company. They did exploration and development. This was, and there was another company called Metamaterials, stock symbol MMAX. They do nanostructures and next generation technologies. They operate on the nano scale, on the micro scale, very small things. Right? Anyway, Metamaterials, they recently developed some laser eye protection for commercial pilots. It was, I believe, funded by Airbus or something. I'm not sure. Anyway, they wanted to be listed on the New York Stock Exchange. They were listed on the Canadian exchange as MMAX. And unfortunately, because it was 2020 and the pandemic hit, people weren't traveling. There wasn't a lot of people flying. Not a lot of airlines were flying at that time. So their product wasn't that interesting. So if we look at Torchlight Energy, also around circa 2020, oil was at negative $47 a barrel because there was a pandemic and no one was traveling. No one was using oil. So Torchlight Energy, the guys who owned it, mostly the board and the shareholders, they wanted to get out of the oil and gas business. They wanted to move into something that could be more profitable. That, because who wants oil at negative $47 a barrel? Well, it turns out that these two companies found each other and they decided to merge because a merger might accomplish both their goals. Let me show you what I mean. Metamaterials wanted to be listed on the New York Stock Exchange if they did a reverse merger with Torchlight Energy, which was already on the New York Stock Exchange. They would be listed as their new company with the stock symbol of MMAT. Now, Torchlight Energy had, they wanted to get into this new high-tech business, and that's their way in, right? But they had some oil and gas assets, so they figured, okay, if you're a Torchlight Energy shareholder, you deserve, some of these oil and gas assets, because, they plan to spin them off, and, they plan to sell the assets and give a dividend of what the assets are worth to the Torchlight Energy shareholders. Seems fair, reasonable, right? So the way it works is that if you were a Metamaterials MMAX shareholder, you'd get 2 shares of the new company. And if you were a Torchlight Energy shareholder, you'd get 1 share of the new company and 1 share of, of these oil and gas assets for sale, right? And on June 28th, the merger happened, and there was 164,923,363 shares of Series A preferred stock that came into existence. This Series A preferred stock is non-tradable, and it represents a share of the oil and gas assets, right? And most of the oil and gas assets are in this thing called the Oro Grande project, which is a new find. And the merger happened about 1 to 2 days earlier than expected, or earlier than announced. So as you can expect, there was probably some Torchlight Energy Torchlight Energy shorts who got stuck, with having a liability for these new shares. Anyway, so there was a large position a large short position in Torchlight at that time, and they have to deliver these Series A preferred shares, and they're non-tradable because they just were not intended to be traded. So how do you deliver something that's non-tradable when you're short that non-tradable item? It's hard. You can't. It's very difficult, right? Anyway, interestingly enough, the Oro Grande project represents about 3.2 billion barrels of oil and a bunch of natural gas across 134,000 acres. It's in Texas, and it's about 40 miles east of El Paso. So when oil's at negative $47 a barrel, it's not worth much, but by October 7th, oil got to around $78 a barrel. And now you got these people who are short, and they might have to pay out a dividend on something that could be substantial. because there's a big difference between negative $47 a barrel and positive $78 a barrel. Well, sometime around October 7th or so, these Series A preferred shares, which became valuable and worth something, they represent a huge liability to short sellers, and that huge liability results in something interesting happening. The Series A on October 7th, the Series A preferred shares automatically converted to something called MMTLP, and they become traded over the OTC exchanges. Now, a lot of people were confused about this, especially Metamaterials, the company, because they had nothing to do with it. Turns out that some market makers got together and decided to make these shares tradable, probably because they wanted to pick up some shares, because there's a huge liability here, because they'll have to deliver on oil and gas assets when oil's at $78 a barrel. They'd probably want to pick up those MMTLP shares from people who own them. Anyway, they started trading on October 7th, 2021. And the price action went sideways, as you saw earlier, right, with the price action. But I'm sure a lot of people got those, I'm sure a lot of those market makers got a bunch of shares along the way. But around April 8th or so of 2022, MMTLP became really difficult to buy, at least via Fidelity, right? It was hard. And oil was around, oil, if you look at oil today, oil is at $110 a barrel. And those oil and gas assets could be worth billions of dollars, which means that's a huge liability if you were one of those Torchlight Energy shorts. So the shorts could be liable for billions of dollars. But that also means that MMTLP shareholders could get billions of dollars, right? I mean, distributed among all the shareholders, of course, across all the shares. Though that's 165 million shares, about billions of dollars. That's a fairly large amount of money per share. Nice dividend, possibly. Anyway, that's the story of MMTLP and MMAT. So how much could this dividend be worth? Now that we know what the dividend, could be, well, let's have a look. This is a calculation from a spreadsheet that I put together a while back, and it takes a lot. I'll go over how the spreadsheet works. Okay, so this is on the assumption that you've got a taxable event with 20% corporate tax and a cash dividend. Okay, so we start with the price of oil. Let's say the price of oil was $80 a barrel. Okay. The COGS cost for oil, I increased this, it's to $35 per barrel. It used to be around $30 in my previous calculations. That means you get a gross revenue of about $45. 80 minus 35 is 45. The value of oil in the ground is a lot less than if you've actually pumped the oil out of the ground, right? It's about a 12% valuation if it's in the ground. And so if you take $45, multiply that by 12%, you get about $5.40. That's what the value of that oil in the ground is. Now, of that, we see that Torchlight has about a 49% revenue interest, so the dollars per barrel there drops down to about $2.65 per barrel. We have 3.2 billion barrels of oil. So that $2.65 across 3.2 billion barrels of oil results in about $8.5 billion. Valuation for oil in the ground, $8.5 billion. Now, take out your 20% corporate tax rate, take out your 10% underwriter's fee. That means that, Torchlight could get something like almost $6 billion. Almost $6 billion. Divide that across 165 million shares, you get about $35 per share, $36 per share. That's a whole lot more than the buck. What is it? The buck 20 or something like that. Buck that it's currently trading at. That's significantly more. Again, I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So I took those numbers, I took those figures, and I put, at $30 into a spreadsheet. And I started at $30 a barrel, moved it all the way up to about $130 a barrel, added some more columns to take it up to about $150 a barrel. So we just took that column, replicated it out from 30 to $150 a barrel, got what the results are, put it into a nice chart. Here's a chart. That's what it looks like. So this is the estimated value of the dividend in terms of dollars per share with a 20% corporate tax rate. We're looking at $35 per barrel COGS cost, 3.2 billion barrels of oil. The discount for the oil in the ground is 12%. The revenue interest is 49%, and we're looking at a corporate tax rate of 20% and an underwriter's fee of 10%, spread across 165 million shares. At current, if we look at what the price of oil is today, that means you could get a dividend of almost $60 a share. Right? If the price of oil drops down to $30 per barrel, of course, that's less than the COGS costs the cost to get oil out of the ground. So you wouldn't get anything. It would be like, negative $3.99. There's no such thing as a negative dividend. So effectively that becomes zero. But the price of oil would have to drop significantly for the value of the dividend to get to very low levels. And this is assuming that they sell the oil and give you cash, which is a taxable event. Suppose they do a non-taxable event, right? By non-taxable, basically I mean a stock swap, right? If you do a non-taxable event, it means you're probably not going to be paid in cash because income in cash would be taxed. So basically, if you're a buyer and you want to do a non-taxable event, the benefit to you as a buyer is you're not paying in cash. You're going to pay via stock swap, so your cash on hand can be used to develop this property. You don't have to worry about dilution of your stock, because you're essentially getting new undeveloped oil-rich property. So it's not really a dilution issue. You're getting something for the stock. The stock value is likely to go up because current owners and investors see this as a positive acquisition, right? You're getting oil, land, and yeah. So generally, if you're a buyer, you want to do this non-taxable event, so if you're a seller, of course, right? If you're like Torchlight, if you're like Metamaterials, of course, there's huge benefits, right? You don't have to pay the taxes on it. So Metamaterials shareholders would get stock from the buyer. With the oil price increasing, we know that Bank of America was projecting $120 in 2022, and JP Morgan was projecting $150 in 2023. This was all prior to the Ukraine war, and who knows where oil prices are going then. But the nice thing is that if you're getting stock, that allows you to participate in rising oil prices, and you would pay taxes when you sell the stock. So generally, stock swaps are the way that these non-taxable events happen, right? So the way it works is the buying company usually doesn't want the new shareholders to dump the stock. So what they'll typically do is they'll sell for more than the straight-up dollar amount conversion, right? Maybe they'll do a 15% overpayment. Who knows? It's not unusual, right? How it works for the buying company, your oil and gas assets, it's immediately put on the balance sheet as an asset, and the assets are depreciated on IRS rules, which means you got 7-year depreciation and all that stuff. So it all works out. Stock swaps are a good deal, right, for both the buyer and the seller. So here's what a stock swap might look like if you were to go through the calculations, right? What we did was we took the same calculations as before, and we dropped the corporate tax rate to 0 because we're doing a stock swap. We're not getting cash. So we take that same calculation, start with the price fall from $30 per barrel, take it all the way up to $130 per barrel, and all the way up to $150 a barrel, and we get a whole bunch of numbers. We take those numbers for the possible dividend, stick it into a spreadsheet, stick it into a chart, and this is what we see. So this chart goes from $30 to $150. At $30 again, you're below the COGS cost, so you wouldn't be getting any dividend. But at $40, you'd be getting, still significantly more than what the price of MMTLP is today. Anyway, this is not financial advice, okay? I'm not a financial advisor. Okay, do what you want. This is just for entertainment and educational purposes only. Non-taxable event seems to be the way it will likely go, okay? So, where are we in this process? What's next? What's going on here? So from the buyer's perspective, rough numbers, right? We got about 3.2 billion barrels of oil. The price of oil today is about $110 per barrel. The cost to pump the oil out of the ground is about $35 per barrel, let's just say. And we know that there's a 12% valuation for oil in the ground. That means you're looking at spending something in the range of $28.8 billion. $28.8 billion. That's a big number. So, and right now we only have test wells, right? So, that $28.8 billion with test wells only represents risk. So, from the buyer perspective, they want the oil, but they don't want the risk. So, they'd like to de-risk, right? The way you de-risk is you convert the test wells to production wells, and then you know that you got oil. So, then it becomes a no-brainer. So, likely the next steps in the process are you want to do some production in that Oro Grande Basin. You want to prove that the wells can produce oil. Once you convert those test wells to production wells, then you're going to do things like increase the bore sizes. You're going to do some lateral drilling and fracking. You're not going to have storage. You're going to sell that oil to a refiner. So you're going to get you're going to get in the oil and gas business. When you're going to get into the oil and gas business, you're not really a high-tech company, right? You're making your money from oil and gas. So you want to spin out that oil and gas company. And that's what you want to spin out that oil and gas company to something called Oilco. And that's what I think is going to happen. So this is pure speculation. And on my part, I have no knowledge. I'm not an insider. I don't know what's going on. This is just saying, saying what would be reasonable. What would be reasonable, okay? So, again, I used the word proved before. So, proved is part of special language that's being used to describe the oil reserves, okay? It's actually special required legal language. It's not something that, it has a meaning. And it basically means, you've got 4 categories. You've got proved developed, proved undeveloped, probable, and possible. And, if you look at the SPE, the Society of Petroleum Engineers, they have specific definitions for this. Basically, proved reserves are those quantities of petroleum which, by analysis of geological and engineering data, can be estimated with reasonable certainty to be commercially recoverable from a given date forward from known reservoirs under the current economic conditions, operating methods, and government regulations. Proved reserves can be categorized as developed or undeveloped. In general, reserves are considered proved if the commercial producibility of the reserve is supported by actual production or formation tests. In this context, the term proved refers to the actual quantities of petroleum reserves and not just the productivity of the well or the reservoir. Proved reserves may be assigned on the basis of well logs, etc., etc., etc. Basically, you got to go into production to get it proved. Okay? For 3.2 billion barrels of oil, the buyer's going to want production data. They're going to want this to be in the proved state, right? Come on. Reserves can be classified as proved if facilities to process and transport those reserves to market are operational at the time of the estimate, or there is a reasonable expectation that such facilities will be installed. So you got to have some way to get that oil out of there. Oro Grande is not developed. Basically, it's just raw land. So, but there's some, roads up there, whatnot, so they can truck the oil down there. But, eventually they're probably going to want a pipeline or something like that. But, yeah, they got to sell the oil, okay? Reserves in undeveloped... reserves in undeveloped locations may be classified as proved undeveloped, provided The locations are direct offset to wells that have indicated commercial production in the objective formation. So basically, if you've got a well that's got commercial production and you've got some test wells next to it, those test wells can get, can get into the proved category, right? But you got to have commercial production, okay? So, possible plan. What would if that's where you want to get to, what would Metamaterials be doing? What would I be doing as a company? I don't know that this would be happening because, again, I'm not an insider, but here's an idea. You want to convert some of those test wells to production wells, right? You want to pump some oil, sell it, get the oil reserves changed from probable to proved, and you want to announce the sale of the oil, and finally, once you've got all that, you can announce the sale of oil and gas assets to a potential buyer, right? So, sorry, let me go back. So, all of the above, pumping oil and selling it and all that requires a spin out, because you got an oil and gas company. You're pumping oil, you're selling it, so you're going to be spinning that out. And that's where Oracle comes in, okay? With that, let's talk about the Form 10-KA. And there's a reason that I'm talking about it now. Form 10-KA came out. It's 189 pages. It's a lot of stuff in there, okay? But they talk about two projects. One is called Project Hazel, and the other is Project Oro Grande. And we were talking about Project Oro Grande. That's at 3.2 billion barrels of oil, right? They didn't talk about Project Oro Grande very much in this Form 10-K. They talked about Project Hazel. Okay, Project Hazel has 2 production wells across 635 acres. In comparison, Oro Grande has 14 test wells and 134,000 acres. Right. If we look at some of the data on page 29, you look at the 4th paragraph where they're talking about the oil and natural gas reserve. They say that as of December 31st, 2020, the company had no proved reserves. Okay? December 31st, 2020. As of December 31st, 2021, the Hazel project consisted of 2 producing wells. Okay? The Oro Grande project consisted of unevaluated properties in the progress of development for future production. They are not yet proved. Okay? As of December 31st, 2021, the Hazel project has proved producing reserves, and the Oro Grande project has no proved non-producing reserves. Okay? Stuff to make note of. Proved producing reserves means good. I put that in green. No proved non-producing reserves means, hey, we got to get those non-producing reserves to be proved. Okay? So, let's read some more, okay? Let's read about these 14 test wells. If we look on page 31, there are 14 test wells. Our current drilling plans, subject to sufficient capital resources and periodic evaluation from the interim drilling results, blah, 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 include drilling additional evaluation wells in the Oro Grande project to continue to de-risk the project and obtain initial production from the development efforts. Sounds as though a little bit like what I was talking about in what would be reasonable to do, that plan. Okay, well, let's fast forward to page 79. It said the company has recorded the fair value of the Oro Grande project at about $72 million. And the fair value of the Hazel project at $3.5 million, totaling a value of $75.5 million. Don't forget, Oro Grande is not proved. That's why it's valued at $72 million. Interestingly enough, they said how many of the Series A preferred shares there are. There are 164,923,363. Previously, I was using the number from a tweet, but now at least it's in a formal document, so it's pretty cool. So, let's look at the Hazel project, right? Hazel project has 2 production wells, 635 acres, and they've proved 152,000 barrels of oil. That's really not a lot compared to Oro Grande at 3.2 billion, okay? The dollar value they assign that is based upon, future net present value with a 10% discount rate. They're assigning those 152,000 barrels of oil a dollar value of about $2.9 million. $2.9 million for Hazel. Okay? Why do I care about $2.9 million? Because I'm going to do something that you shouldn't do, but it's semi-reasonable. Okay? I'm going to look at Oro Grande in the context of Hazel, right? Oro Grande has 3.2 billion barrels of oil. Hazel has 152,000 barrels of oil. If Hazel was valued at 2.9 million, what would Oro Grande's 3.2 billion be valued at? Somewhere around $16 billion. Okay? Again, we've only got a 49% stake. So, we wouldn't be getting $60 billion. But still, that's the value of all the oil in the Oro Grande Basin. That's a hell of a lot more than, that's a hell of a lot of oil. That's a hell of a big dollar. Okay? You want to get proved. If you can do to Oro Grande what's been done to Hazel, that's a huge potential windfall. Okay? And that ends my talk about the 10KA. And this is why I was interested in the 10KA. And that also ends the video about MMAT and MMTLP. Again, let me state, I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. And with that, I bid you good night. Goodbye.